question comes from the line of Mona Ketan from Dolat Capital. Please go ahead.
Yeah, hi sir. I just had two additional questions. So, firstly, you mentioned that there's this plan of big investments this fiscal as well. On the OPEX to assets, we had OPEX to assets of 3.5% or so this fiscal. So, could this continue to be at similar levels, or will the other OPEX growth of 28% over the last 2 years moderate given the high base?
So, very good question, Mona, and this is something which I have been telling to all investors, including investor calls in past, that we will significantly increase our investments primarily into 4 parts. One is distribution, one is people and leadership, including customer acquisition, mostly in technology for the next 2 years, and fourth is building channels, including digital and other and partnerships and things like that. So these 4 investments will do come what may. So given that perspective, yes, OPEX will go up because this is not cost, this is investment, and each of these investments has a clear payback period. And I said that by FY30, SBS 2030 as we call it, our cost to income kind of a target is somewhere between 40 to 45%. Having said that, I said in the short run, our cost to income target is between 55 to 60%. We have retained within that this year. Next year probably will be at the tipping point out there. Maybe a few basis points open niche ho sakta hai. But from next year onwards, again we'll be in the range between 50 to 60, and it will gradually start tapering down every year to 43% by FY30. So that's my plan, and it will exactly play out that way.
Okay, got it. And just finally on the retail growth, so we have seen a very strong growth in other retail. So where is this coming from? If you could share some details around it.
It's coming from a low base, Mona. So our retail growth has not yet started, frankly. Okay. So what you are seeing is primarily because we have started nibbling bits and pieces here and there. Because I'm very clear with the team that we will not grow retail till we have our systems in place, till we are able have the right to ask the right business from the right partner, and till we get our branch distribution on retail cross-sell well, and till we get our liability franchise where we have the acquisition machinery working like a machine to which we can cross-sell. So frankly speaking, none of those things will take off till FY25. FY25 we will start seeing some green shoots out there. Right now it is basically low base, and we are doing bits and pieces here and there. That is showing it up. But you will see, what I told before, I said that by FY 2030, we will have 20% gold, 30% retail, 20% SME, and 30% wholesale and other businesses, including securitization and everything. Okay. So if you have to go to 30% retail, where are we in retail? I mean, we have to go there, right? So you will see a significant scale up in retail between FY 27 and 30. And between FY 25, for the first time, we'll start seeing the real growth happening. What you are seeing is basically on a low base. We have started bits and pieces everywhere. That is what is showing, including agri, microfinance, a little bit of a PL, some of the home loans, some of these labs, some of these businesses here and there. So these are all showing up little bit bits and pieces. But this is not the real journey. Real journey will start only post FY25 after our system processes are in place. Because I have done this business enough to tell that we should not scale this business unless all our machineries are ready. And by that, we'll be actually picking up a faster pace than doing it now and then taking 2 steps forward, 1 step backward. I'll not do that in retail. We'll only go all out only once we are fully ready. And this growth you're seeing is basically because of low base.
Okay. So the systems are expected to be in place only by FY25?
No, the retail asset systems will be placed all by FY24. Okay. Mid to end. But then what happens is, based on my experience, I can tell you that once the systems are in place, you need the channel machinery to work, you need the cross-sell machinery to work. Also, what we need is customers, right? So we are starting that entire sales machinery of customer acquisition. And what we'll do is, because we have digital access now, unlike 20 years back, so onboarding of customers will happen with some retail asset businesses as well, because of the digitized ecosystem. So all of that stuff will happen this year, and that experience of cross-sell, all said and done, technology to Rajesh will deliver. But we have to ensure that the culture of retail assets cross-sell in the branches. So I'm getting the team to get activated towards that. With the sales team, they will have a separate strategy. With the branch banking, they will have a separate strategy. With the OCC, which is outbound contact center, they will have a separate strategy. And only these three machineries are working fine. Then we will look at DSAs and dealerships and all that and start building the businesses, not the other way around. Because we should go with a strength and not looking for businesses because our other businesses are not happening. So that's the way we'll build retail businesses. So to that extent, yes. The short answer to your question is systems will all be ready. Only system which will not be ready this year will be core system. Core system will come in FY25 because that is something which we are not going to compromise. We'll get the best of the best, and hence that will take a little while. That will come by FY25, and then everything gets integrated around the core system.
Sure, got it. Thank you. That was very helpful.
Thank you, Mona. Chirag, any further questions?
Ladies and gentlemen, due to time constraint, we take our last question from the line of Pallavi Deshpande from Samiksha Capital. Please go ahead.
Yes, sir. Thank you for taking my question. Just previously you mentioned about the special deposits. So what would be the share of that in the total deposit mix? And secondly, on the NBFC side, just seeing some exposure picking up to that. So what kind of NBFCs would we see?
Typically, I don't have that exact data, but I think we have always worked on a 30-70 kind of a model where 30 is large ticket. For us, large ticket is very small ticket also from an ecosystem perspective. But whatever you can call as special rates, special deposits, generally it has been 30-70. Maybe it would have gone up a little bit last quarter, but again, it will come back to somewhere around 30-70 or 35-65 because most of these are relatively, it is not more than a year or 6 months kind of a thing. Also, you must understand that we ran off our CD book completely almost, right, which I told. From fairly 500 something we had CD book, we brought it down to 95 crores. So 594 to 94 crores. So we ran off almost 500 crores of CD book last year. So given that, I think we had that special dispensation in a way to build some book on a shorter term basis, which we have done. And hence we have buffer on CD and things like that. And CD rates are coming down and things like that. So it will be a play of all of this till our entire CASA franchise machinery fully picks up. So I'm not so unduly worried on this percentage, but it may have gone up a little bit this quarter compared to what we generally have around 30-70. But I'm giving a very broad picture. I exactly don't have the data in front of me.
Yes. And so on the NBFC exposure, that's at 8.8%, versus 7% in the third quarter. So, what are we seeing in that space?
Mr. Divakar, you would like to answer that question? After that, I'll top it up. I don't think Mr. Rivera is able to answer this. Maybe he's not able to connect. So I'll answer this. So what has happened is, when it comes to NBFCs, we always do at a category of A plus category. We do.
For advances, NBFCs are A rated and above. So out of this total 3,000 and odd exposures towards NBFCs, 94% is A and above type of accounts.
Right. And so would this be primarily vehicle finance or the diversified financial?
No, it's not vehicle finance. It's very, very highly diversified. A lot of this is to do with home loans and those kind of businesses. So these are highly diversified. In fact, not too many is vehicle actually.
Right. And so lastly, on the recoveries from written-off accounts, what would the figure have been for this year? I guess it would be part of the other income.
Sorry, I didn't get the question.
The recoveries from written-off accounts, how much would that have been this year versus last year? And I'm talking about the amount that's included in the other income from this.
No.
Yeah, Mr. Divakar, I'd like to answer.
Yeah. Prudentially written off recovery. This year it is 70 crores. Last year it is 77 crores.
Right. Okay. And this would be how much out of the 70 would have been part of the other income?
Nothing.
No, it has been correct. That's what it is netted up against the provisions to be.
Okay. Right.
That is a new regulation, right? I think that's the new regulation, no, Mr. Divakar, that you have to net it out. Yeah.
Okay. Right. Thank you, sir. That's all from my side.
Thank you. Ladies and gentlemen, we have reached the end of the question and answer session. I now hand the conference over to Mr. Pralay Mondal, Managing Director and CEO, for closing comments.
Thank you very much. I would really thank everybody to patiently listen to our commentary and ask very relevant set of questions. What I can commit is, on behalf of the management, that everybody is very excited to build the bank based on the SBS 2030 vision. The first installment is delivered this year, but more excitement to come in the next few years. That much I can commit on behalf of the management. Thank you very much.
Thank you, sir. On behalf of Axis Capital Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.